Have you ever, poured your hard-earned money into an investment hoping for that big growth, only to find yourself staring at a loss, a significant one?
Oh, yeah, it happens. It's a pretty common and, frankly, painful experience for a lot of people.
Definitely painful. And when it does happen, this really crucial question pops up. Okay, how much of that loss can I actually deduct, to maybe soften the blow on my taxes?
Right. It's rarely as simple as just, writing off the whole thing, is
Yeah.
it? The IRS, well, they have very specific rules, sometimes kind of surprising rules.
Absolutely. And that's exactly what we're unraveling today in this deep dive. Passive activity loss limits. It fits right under that big umbrella of investor losses.
A big topic.
It is. And our mission today is really to cut through the complexity, clarify how much of these losses you can deduct. We'll be focusing pretty heavily on the difference between passive versus active income.
Which is key.
Trust me, understanding this distinction, it can have, well, massive financial implications for you. But before we dive deeper, just a quick reminder, this deep dive is based on material from Farhat lectures.
Great stuff.
All the content, examples, explanations we talk about here, they're derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, definitely visit the website.
Yeah, lots of practice questions, video lectures.
Exactly. Detailed support to really reinforce today's topic. And special thanks to Professor Farhat for providing this valuable material.
Okay, so just to connect back quickly, we talked before about at-risk limits, right? That's always hurdle number one for any loss.
Right. The first check.
You can only deduct losses up to the amount you're genuinely at risk for. So, think cash you put in, property you contributed, maybe loans you're personally on the hook for.
Makes sense?
Once you've cleared that hurdle, the next big question the IRS asks is, okay, is this activity passive or is it active?
Ah, the passive versus active split.
Exactly. And to help sort this out, they've basically categorized all your income into three distinct buckets: active income, portfolio income, and passive income.
3 buckets.
Understanding these buckets, I mean, that's really the key to unlocking whether you can deduct those losses or not.
Okay, so let's crack open these income buckets then. Let's start with active income. Seems pretty straightforward.
Yeah, it mostly is what it sounds like.
This is money you generate because you're, actively involved, right? You're engaged in the activity, putting in the work. Our sources point to the classic examples, your regular salary, wages from a job, maybe guaranteed payments if you're a partner in a firm.
Or just running your own business.
Right, or business income where you, the taxpayer, are materially participating. We'll get into what that means later, I'm sure.
Oh, definitely.
But to make it super clear, imagine you own a farm. If you're actually out there working the land, planting, making decisions every day.
Getting your hands dirty?
Yeah, that hands-on effort, that generates active income.
Okay, so that's active. Then, kind of the opposite end, we have portfolio income.
Right.
This is essentially where your money is working for you instead of you actively working for the money,
Like investments.
Exactly. Your typical investment. Think capital gains when you sell stocks, interest from bonds or savings accounts, dividends from shares, annuities, royalty income, that kind of thing.
So income that just flows in from your investments without you having to manage the company day to day.
Precisely. It sits in its own separate bucket. It's not active, it's not passive, it's portfolio.
Okay, which brings us to bucket number 3, passive income. This is where it gets interesting, right?
This is often where the confusion comes in.
So passive income is income from a trade or a business or some income-producing activity where you, the taxpayer, do not materially participate.
The key phrase, do not materially participate.
Let's go back to that farm example. This time, okay, you own the farm, you put your money in.
Capital's at risk.
Right, but you never actually visit. You don't plant anything, you don't make any operational decisions. Someone else runs the whole show for you.
You just get a check. Or maybe a loss statement.
Exactly. At the end of the year, they send you a statement showing your share of the profit or loss. In that scenario, because you're not actively involved,
You're just an investor.
your income, or potentially your loss, is considered passive.
And this distinction, active versus passive, it seems simple on the surface, but it has this really interesting history and a huge impact.
Yeah. Tell me about that.
Well, these categories became super critical back in the 80s. Why? Because passive activities, especially real estate rentals, were being used like crazy as tax shelters.
Ah, the tax shelter angle. I've heard about this.
Yeah, so the story goes you had these high-income folks, doctors, lawyers, executives, with big W-2 salaries or active business profits.
Okay.
They'd go out and buy rental properties. They'd generate losses on paper, through depreciation, high interest maybe, but they weren't actually managing these places.
They were just silent partners, basically.
Exactly, just investors. Then they try to take those passive losses and use them to wipe out their active income from their day jobs.
Reducing their tax bill significantly, I bet.
Hugely. So the IRS eventually said, whoa, hang on, nice try, but no. They stepped in and closed that loophole.
How? What was the rule?
They established this core principle. Generally speaking, you cannot take losses from a passive activity and use them to offset your active income, or your portfolio income for that matter.
Okay, so passive losses can only offset.
Passive income. It's like they have their own little ecosystem. Passive losses stick with passive income.
Almost like a separate ledger, just for your passive stuff.
That's a great way to think about it, yeah.
So what happens if you have a passive loss, but you don't have any passive income that year? Does the loss just vanish?
No, thankfully not. It gets suspended, which basically means it's put on hold, carried forward to future tax years.
Okay, carrying forward until?
Until you either generate enough passive income in a future year to absorb it, or until you completely dispose of that specific passive activity investment.
Ah, okay, so you get it eventually, maybe.
Eventually, yes.
Yeah.
And it's really important to remember, rental real estate is almost always considered passive right from the start, like automatically.
Why is that? Just because of the history?
Mostly because of that historical abuse we just talked about. Now, there are two very important exceptions to that rule, which we'll definitely get into.
Because I was wondering about that.
But for other businesses, like a Schedule C sole proprietorship or an S Corp or a partnership, those can be either passive or active.
Yeah.
It all hinges on your level of participation.
Okay, so that blanket passive label for rentals really shows how big of a problem the IRS thought it was.
Exactly.
All right, so the big takeaway here is passive losses generally only offset passive income, which means we really need to understand what counts as a passive activity.
Absolutely critical.
And to figure that out, it sounds like we need to answer, 3 core questions?
That's right. 3 key questions. First, what exactly counts as an activity? Like, how do you define the boundaries?
Okay, what's the activity?
Second, what does material participation really mean? We've used the term, but what are the actual tests?
The nitty-gritty of participation. Got it.
And third, when is an activity automatically treated as a rental activity? Which usually means it's passive unless an exception applies.
Activity, participation, rental. Okay, let's tackle the first one, identifying the activity. What does the IRS say?
Well, the Treasury regs define it kind of formally as one or more trade or business activities or rental activities that form an appropriate economic unit for measuring gain or loss.
Okay, appropriate economic unit. Sounds a bit vague.
It is a bit. But basically, it means you have some flexibility. You can treat each business or rental property separately, or you can group multiple things together if they make sense as a combined economic unit.
How do you decide if they make sense together?
You look at relevant factors, similarities, common control, common ownership, geographic location, how interdependent they are. The IRS gives you leeway.
But there's a catch, right? You mentioned something about permanence.
Yes, huge catch. Once you decide how to group your activities, that decision is generally binding for future years.
Yeah.
You can't just regroup them whenever it suits you, like to maximize loss deductions one year and then split them the next.
Ah, so you got to get it right the first time.
Pretty much. Unless the original grouping was clearly wrong or there's been a major material change in the facts and circumstances. So that initial grouping decision is really strategic.
And the financial impact, how you group them could really change your tax bill, couldn't it?
Oh, absolutely. Massive difference. Let's take Maggie. She has 2 business units, X and Y.
Okay.
She materially participates in Unit X, and it makes $100,000 in income. So that's active income.
Good for Maggie.
But she doesn't participate in Unit Y and has a $37,000 loss. So that's potentially a passive loss.
Okay, $100K active income, $37K passive loss.
Now, if Maggie can group X and Y together as one single activity, maybe they're related, operated together, what happens.
Well, if it's one activity and she materially participates in part of it, does that make the whole thing active?
If she materially participates in the combined activity based on the tests, yes. But even if not, if they're grouped, the $37,000 loss from Unit Y can directly offset the the $100,000 income from Unit X within that single activity group.
Ah, okay. So the loss nets against the income before we even worry about passive versus active limitations between activities.
Exactly. So her net income from the combined activity would be $63,000. And if she materially participates in the combined unit, it's $63,000 of active income. Big difference.
Huge difference compared to what? What if she can't group them or chooses not to?
Then Unit X still spits out $100,000 of active income, fully taxable. And you know why? $37,000 loss. That's a passive loss.
Which she can't use against the active income.
Nope. Gets suspended, carried forward.
Yeah.
So her taxable income that year is much higher if they're separate. It shows how critical that grouping decision is.
Wow, okay. That makes sense. What about Maria? You mentioned she had vape stores and restaurants in different cities.
Right. Maria's situation shows the flexibility. She has a vape store and a restaurant in Maryland and another pair in Boston.
So 4 businesses total.
She has lots of options. She could group all 4 together, maybe arguing common ownership and management.
One big activity?
Or group by geography.
Mm.
The 2 Maryland businesses together, the 2 Boston ones together.
Okay, 2 activity.
Or group by type. The 2 vape stores together, the 2 restaurants together.
Also 2 activities, but different ones.
Or treat each of the 4 as completely separate, standalone activities.
4 activities. So she has to really think about which grouping makes the most sense economically and potentially for netting income and losses down the road.
Exactly. That flexibility is powerful, but you need to consider the long-term impact because of that permanence rule.
Okay, so identifying the activity is step 1, and it's strategic. What about step 2, material participation? What does that actually mean?
This is where the IRS gets very, very specific. They lay out 7 distinct tests. You only need to meet one of these 7 tests for a given year to be considered a material participant.
7 tests. Okay, hit me. What are some of the main ones?
Well, the most straightforward one is just raw hours. Did you participate more than 500 hours in the activity during the year? If yes, boom, you materially participate.
500 hours. That's like 10 hours a week, roughly. Okay. What else?
Another one is if your participation was basically all the participation. So if you were the only one doing anything significant, even if it was less than 500 hours, you likely meet this test.
Like a solo operation.
Right. Or test 3. You participated more than 100 hours, and that wasn't less than anyone else's participation. So you're putting in significant time, and nobody else is doing more.
100 hours plus being the main person, or tied for main person. Got it.
Then there's one for people juggling multiple things. It's called the Significant Participation Activity, or SPA test. If you participate more than 100 hours in several different activities, and your total time across all those activities where you hit the 100-hour mark adds up to more than 500 hours total for the year, then you materially participate in all of them.
Whoa. Okay, so even if one activity is only, say, 120 hours, if you have 4 others like that, you hit the aggregate 500 and they all become active.
That's the gist of it, yeah. It catches people significantly involved in multiple ventures.
Interesting. What are the other 3 tests?
There are look-back rules. Did you materially participate in the activity for any 5 of the last 10 years? If so, you're still considered material now, generally.
So past participation counts.
It can. And for personal service activities, think law, accounting, health, consulting. If you materially participated for any 3 prior years, that counts too. It recognizes ongoing professional involvement.
Okay. And the last one, you said 7.
The last one is the fuzzy one, the facts and circumstances test. Basically, if you don't meet any of the other 6, can you still prove, based on everything you did, that your involvement was regular, continuous, and substantial?
Sounds like you'd need good records for that one.
Absolutely. It's a harder one to rely on, but it's there as a catch-all.
Okay, 7 tests. Meet any one and you're active. But just as important, what kind of work doesn't count towards these hours?
Great point. The IRS is clear that investor-type work generally doesn't count.
Meaning?
Things like just monitoring your investment, reading financial reports, approving capital expenditures only in your capacity as an owner, protecting your investment.
So, stuff any investor would do, even passively.
Exactly. Attending board meetings sometimes falls into this category too, if it's purely oversight. Raising capital, arranging financing, often viewed as investor activities, not operational participation.
So you can't just count hours spent worrying about your money. It has to be operational involvement.
Right, managing the actual business or trade.
Let's try a practical example. John, our CPA, he's got his active CPA practice income, $450K. He also owns interests in 2 other activities, B and D. He doesn't materially participate currently.
Okay.
Activity B has a $20,000 loss. Activity D has $15,000 of income. Since he doesn't participate, they're both passive, right?
Correct. Both passive.
So what happens with the loss and income?
Since both are passive, he can use the $15,000 passive income from D to offset $15,000 of the passive loss from B.
Okay, so he uses most of the loss.
Right. He's left with just the $5,000 suspended passive loss from B carried forward. The $15K income is effectively sheltered.
Now, here's the strategy question. What if John decides, hey, I'll put in an extra 50 hours into activity D, enough to push him over one of those material participation thresholds for D?
Okay, so he makes activity D become an active business for him.
Sounds good, right? Active income, maybe.
You'd think.
Yeah.
But watch what happens. D's $15,000 income is now active income. It's fully taxable.
Okay.
But activity B, where he didn't increase his hours, it's still passive. And its $20,000 loss is a passive loss.
And the rule is?
Passive losses can't offset active income. So by making D active, John suddenly makes that $15,000 income taxable, and he loses the ability to offset it with the loss from B.
Wow. So he'd actually be worse off tax-wise by participating more in D in this specific case?
In this exact scenario, yes.
Yeah.
It's counterintuitive, but it shows you really have to analyze the interaction between your different activities. Sometimes keeping something passive is better if you have passive losses elsewhere to absorb the income.
That's a fantastic illustration. What about Jane, the attorney with the restaurant loss? She worked 450 hours managing. Her husband, Julian, did 80 hours marketing, total 530 hours.
Okay, 530 hours combined.
Does that count? Can you combine spouses' hours?
Yes, absolutely. For the material participation tests, a spouse's participation hours are treated as your own. So 530 hours is over the 500-hour threshold.
So Jane is a material participant. The restaurant loss is active.
Looks like it. But wait, there was a detail in the source material. She also did 20 hours of janitorial work.
Yeah, 20 hours cleaning up. Does that count?
Generally, no. Work doesn't count if it's not the type of work customarily done by an owner, and one of the principal reasons for doing it is to avoid the passive loss rules. Cleaning might fall into that, depending on the circumstances. But even without those 20 hours, their combined 530 hours of management and marketing clearly meets the 500-hour test.
Okay, so she's active. Good example of combining spousal hours.
Mm-hmm.
All right, that takes us to the third big question. Rental activities. You said they're automatically passive, usually.
That's the default starting point, yes. Because of that history we discussed, assume rental passive.
But you mentioned exceptions, the life rafts for rental property owners.
Exactly. Two crucial exceptions that can let you deduct rental losses against other income.
Let's hear them. What's the first one?
The first is often called the mom and pop exception. It's officially the $25,000 offset for rental real estate activities.
Mom and pop. Okay, what's the deal?
It allows taxpayers, not huge corporations, generally individuals, to deduct up to $25,000 of net losses from rental real estate against other types of income.
Other types, like my salary.
Yes, like your active income or even portfolio income.
Mm-hmm.
This is a direct exception to the passive-only offsets passive rule. It's a big benefit.
Up to $25,000. Are there catches? There are always catches.
There are definitely catches. First, there's an income phase-out. That $25,000 potential deduction starts to shrink once your adjusted gross income, your AGI, goes over $100,000.
Okay, how does it shrink?
It's reduced by 50 cents for every dollar your AGI is over $100,000. So by the time your AGI hits $150,000, the $25,000 deduction is completely gone, phased out entirely.
100K to 150K phase-out range. Got it. What else do you need to qualify?
Two main things. You need to actively participate in the rental activity,
Yeah.
and you need to own at least 10% of the value of the activity.
Okay, actively participate. Is that the same as materially participate, those 7 tests?
No,
Yeah.
Thankfully, it's a lower bar. Active participation doesn't require regular, continuous, substantial involvement like material participation. It just means you're involved in making significant management decisions.
Like what kind of decision?
Things like approving new tenants, deciding on rental terms, approving significant repairs or capital expenditures, setting the rent prices. You can hire a property manager for day-to-day stuff, but you still have to be making the big calls.
Okay, so less demanding than material participation, own 10% and watch that AGI limit. Let's try Mario's example. His AGI is $120,000.
Okay, so he's within the phase-out range.
He has a big $75,000 loss from a rental where he actively participates. He also has $15,000 of passive income from a different rental property.
All right. Step 1, always Net the passive stuff together.
Mm.
His 75K loss can absorb the 15K passive income.
So 75K minus 15K leaves $60,000 of remaining passive loss.
Correct. Now, can he use the mom and pop exception for some of that 60K? His AGI is 120K. That's $20,000 over the $100 threshold.
Okay, 20K over. And the reduction is 50% of that excess.
So 50% of $20,000 is a $10,000 reduction to the maximum $25,000 allowance.
$25,000 max minus $10,000 reduction means he can deduct $15,000 under the mom and pop rule.
Exactly. He gets to deduct $15,000 of that remaining rental loss against his other income, like active or portfolio.
So total deductible loss for Mario this year is the $15K he offset against passive income, PLUS, the $15K from the mom and pop exception, $30K total.
Perfect. $30,000 deductible now. The remaining loss, 60K, 15K equals 45K, gets suspended and carried forward. It really shows how that exception works.
That's a huge help compared to just carrying it all forward. Okay, what's exception number 2 for rental real estate?
Exception number 2 is for the real estate professional. This is a much tougher one to qualify for.
Sounds serious.
It is. It's designed for people whose primary business is real estate. To qualify, you basically need to meet 2 tests in a given year.
Okay, what are they?
First, more than 50% of all the personal services you perform and all trades or businesses during the year must be in real property trades or businesses where you materially participate.
So real estate has to be your main gig, time-wise?
Pretty much. And second, you must perform at least 750 hours of services during the year in those real property trades or businesses where you materially participate.
750 hours and more than half your total working time? That's a high bar.
It really is. But if you meet both of those tests,
What's the payoff?
the payoff is huge. If you qualify as a real estate professional, your rental real estate activities where you materially participate are not treated as passive. They're treated as active.
Meaning the losses can offset any income, W-2, business income, anything.
Exactly. The passive activity loss limits essentially don't apply to those specific rental activities for you. It's a complete game changer for people heavily involved in real estate.
Any quirks with this one, like the spousal hours?
Good question. Unlike the general material participation tests, for the 750-hour requirement for the real estate professional exception, your spouse's hours do not count towards your 750. It has to be your personal service time.
Okay. That's a key difference. And what about working as an employee for a real estate company?
Generally, employee services don't count towards the tests unless you own more than 5% of the employer company. So just being a W-2 employee in real estate usually isn't enough on its own.
Got it. So 2 exceptions. Mom and pop, 25K offset, active participation, AGI limits, and real estate professional. High bar turns rentals active.
Those are the main ways around the default passive nature of rentals.
Okay, one more scenario. What if you have an activity that was passive, but you change things? Like you take over managing that farm you used to just invest in, it becomes active. What happens to old losses?
The transition from passive to active. This is often good news, especially if you've got those suspended losses piling up.
Yeah, how so?
When an activity flips from passive to active because you now materially participate, any suspended passive losses from prior years when it was passive can be used.
Use stands what?
They can be used to offset the income generated by that same activity in the current year, even though the activity is now active.
That's interesting. So the old passive losses can wipe out the new active income from the same place.
Exactly. Up to the amount of the current year's income from that specific activity.
What if the old losses are more than the current income?
Any remaining suspended loss after offsetting the current year's income from that activity stays suspended. It's carried forward.
Can it then be used against future income from that now active activity? Or other passive income?
Yes, it can offset future income from that formerly passive, now active activity. And importantly, it also retains its character in a way, allowing it to offset income from other passive activities you might still have.
Okay, let's use Lisa's example. She had $50,000 in total suspended passive losses from one activity over several years.
Okay, a big chunk of suspended loss.
This year, she ramps up her involvement, becomes a material participant. The activity is now active for her.
Right.
Her share of the income from that activity this year is $30,000.
Okay, $30,000 current active income from the formerly passive activity.
So what happens with her $50K suspended loss?
She can use $30,000 of that $50,000 suspended loss to completely offset the $30,000 of current income from that activity.
Meaning she pays zero tax on that $30K income this year.
Correct. The suspended loss shelters it.
And what about the remaining loss? $50K minus $30K used leaves $20K.
That remaining $20,000 stays suspended and is carried forward to future years. It can offset future income from this activity or income from any other passive activity she might have.
That's a really helpful rule. It means those losses aren't necessarily lost forever just because the activity status changed.
Exactly. It provides a pathway to eventually get the tax benefit from those earlier losses.
So wrapping this all up, what does this really mean for someone listening? We've gone through buckets, participation, rentals, exceptions.
It means the tax treatment of your investments, especially if they generate losses, is really tied to how involved you are or aren't.
Right. Active, portfolio, passive, those distinctions matter hugely. Material participation is key for non-rentals. Grouping activities needs careful thought up front.
And for rental real estate, knowing those mom and pop and real estate professional exceptions is critical if you have losses you want to deduct against other income.
It really highlights how tax law isn't just about numbers. It reflects, past economic behavior, policy goals trying to prevent shelters.
Absolutely. It's a complex dance between the rules and real-world incentives. And understanding it really allows for strategic decision-making.
It's not just compliance, it's seeing how your own level of engagement directly shapes your financial results, at least on the tax side. So maybe the provocative thought for you listening is looking at your own finances. What activity might you want to deep dive into next, considering these distinctions? Is something passive that maybe could be active, or vice versa?
Yeah. How does your current involvement line up with the tax treatment you're getting or the treatment you want to get? It can make a real difference to your bottom line.
We've really only scratched the surface here, haven't we? These concepts are complex.
They definitely have layers.
So for more in-depth practice, those video lectures we mentioned, detailed support to really nail these topics down, we absolutely recommend visiting farhatlectures.com.
Great resource to solidify your understanding.
Well, thanks for joining us on this deep dive into passive activity losses.
Always a pleasure to unpack these rules.
And we'll see you next